All right, let's dive into Delek Logistics Partners, that's ticker DKL, and their latest earnings report for Q2 2025. Now, on the surface, the market did not like what it saw. But as you're about to see, those headline numbers, they really don't tell the whole story. So first, let's look at exactly how the market reacted. So here's the immediate reaction. The stock closed down 2.4% on earnings day. And get this, it was trading on about 5 times its normal daily volume. So yeah, investors saw the headlines and a lot of them just hit the sell button. The big question is, why? Well, here's your answer. It was a classic top and bottom line miss. Delek missed what the analysts were expecting on both of the big numbers. GAAP earnings per share, it came in at 83 cents, but the street was looking for 87 cents. And revenue? $246 million, which fell short of the $256 million consensus. So you can see why that initial reaction was so negative. Seeing those misses, you can totally understand the stock dipping, and that really brings us to the main question we need to answer here. Was the market's knee-jerk reaction the right one, or is there something much more interesting going on under the hood? And this, right here, is where the whole story changes. Because while revenue and EPS missed, Delek quietly posted a record-breaking quarterly adjusted EBITDA of $120.9 million. I mean, this isn't just a solid number. It's the best quarter in the company's entire history. It points to some serious operational strength that those headline numbers just completely glossed over. And this wasn't some kind of fluke. That record result, it's an 18% jump in adjusted EBITDA compared to the same quarter just last year. We're not talking about a small beat here. This is significant, accelerating growth, and it's being driven by the company's core strategy. Okay, and this next number just shows an incredible commitment to their shareholders. The company just announced its 50th consecutive quarterly distribution increase. Think about that. 50 quarters in a row, they've raised the payout, which is now over $1.11 per unit. That kind of consistency is a massive signal of confidence for management about where things are headed. So how are they pulling this off? How are they generating these record results? Well, it all comes down to their 3-part playbook in the Permian Basin. First, they're completing huge infrastructure projects, like their Libby 2 gas plant. Second, they're integrating some really key water acquisitions. And third, they're cashing in on their unique ability to handle the entire energy stream. And you can tell management is completely locked in on this vision. The company's president, Abigail Sork, said it perfectly on the call. She said they're making substantial progress to become a premier, full-service provider in the Permian. This isn't just about moving one product anymore. It's about controlling that whole midstream value chain. And this is the key to their whole strategy. They call it their 3-stream advantage. What it means is that in the Delaware Basin, Delek is one of the only games in town that can handle everything a producer needs: crude oil, natural gas, and water. It's an integrated system, and it is a massive competitive advantage. It makes customers sticky and opens up doors that their competitors can't even knock on. Because of all this operational strength, management didn't just meet expectations for the future. They came out and reiterated their full-year guidance for adjusted EBITDA, which is between $480 and $520 million. And they specifically said they are increasingly confident in hitting that number. That's a huge sign of strength, especially when some of their peers have been lowering their forecasts. You know, there was a great question on the analyst call about sour gas that really highlighted their strategy. See, some competitors might just offer treating capacity, but Delek offers the whole shebang: gathering, treating, and processing. For producers, it's a much more complete and honestly a much more valuable system. Now, with over $1 billion in liquidity, everyone wants to know about acquisitions. Management was really clear here. They've got 3 strict rules for any deal. It has to immediately add to free cash flow, and it has to improve their leverage and their coverage ratios. They also made it known that they aren't married to an asset, meaning they'd be willing to sell something if it creates the most value for investors. Smart. All right, so let's pull all this together. What's the bull case here? Well, you've got powerful EBITDA momentum. You have management confidently sticking to their full-year guidance. You've got a super healthy 1.22 times distribution coverage ratio, which means that payout is safe. And you've got over $1 billion in liquidity to fuel more growth. That is one very, very strong foundation. So where's all that strength actually coming from? The hero of the quarter was definitely the gathering and processing segment. It surged to $78 million in adjusted EBITDA. And this wasn't by accident. This growth came directly from integrating those water acquisitions we talked about. It's proof their Permian playbook is already working. So, putting it all together, what's our final call? For us, it's a clear outperform. We think the market completely overreacted to the headline noise and totally missed the powerful operational story that's unfolding. The record EBITDA, that 50th straight distribution hike, and the confident guidance, it all points to a company with fundamentals that are ready to drive this stock higher. Of course, everything we've talked about is an analysis of publicly available information. It is not financial advice. You should always do your own research before making any investment decisions.